Yeah, Pete, with your question, that would normally be the way that a lot of people would get in. They would either on a pullback, or they would get in as it broke to a new high. I'm just kind of curious what you guys preferred. I've found over the years working with people that the majority of people preferred reversals, but not everyone was very successful at choosing reversals or getting good points there. So the polls staying pretty consistent, and you can select more than one answer. But even though you can select more than one answer, with all of you having voted now, 92% on the reversals, 50% trade continuation moves, 42% breakout, breakdown, 42% momentum. So it's pretty clear that by far the preferred strategy is reversals. And we're going to go into the reversals today, start looking at trying to identify them. And I didn't try to load this by making that the first answer, by the way. I've just I put them in there because I felt that's probably where things would end up. And ironically, that's exactly where it ended up. Number 1, 2, 3, 4. And they were exactly in that order for your choices. The reason that I see that, just in working with people, there is a comfort level with certain types of trades. And since so many of you have the same comfort level, certain types of trades, what my goal is to say, let's look at how we can improve that type of trading. Because if you talk to a lot of traders, they will tell you that trading reversals is a newbie strategy. That's a failing strategy. But bottom line, it is something that can be done very successfully if we know what to look for. So I'm going to close the poll out here. And I think you guys should now be seeing the title screen. If I could just get a quick a yes if you've got video. Okay, looks good. I guess we'll let that stand for our audio test too, because you wouldn't have heard me if I didn't say that. So sounds good. We'll get going here then. Again, today, as we go through things, if you have questions, throw them out there. If I can address them without interrupting the flow of the presentation, I will do that. Otherwise, I will come back to the questions. And there were a couple yesterday that I missed comments because I couldn't get this window to work correctly. And then when I finally detached it from my control panel, it allowed it to start working. So we'll try to keep on top of those today. But like I say, if you've got questions, feel free just to put them out there. I'll work them in as we go. Here's what we're going to do. We're going to start again with our disclaimer, just a word of warning, and we say it every time. It is a serious business that seriously hurts people, and it does need to be done with money that you can afford to risk. We're going to try to show in the course of this, and we'll probably go through this tomorrow, but we're going to try to show how we can minimize that risk to the point where we can make good decisions emotionally, be in a good mental state as we're trading, and yet still be risking money and still be making some money. But, we have to realize, especially for the futures, those are pretty good sized contracts. A lot of times we get distracted by the fact that the margin is $500 and it doesn't sound like it's that big of a deal. But you have to realize that something like the S&P, if you want to figure the actual value of the contract, you multiply wherever the S&P is. If it's at 1100, you multiply that by $50, and that's the actual value of the contract. So frequently, we're talking about a contract that is somewhere $60,000-$65,000 contract. Now, we think about stocks. There's no way we could go trade a $65,000 position for $500 of margin, but that's what people are doing when they trade futures. So it can be pretty easy to get a $200,000 or $300,000 position, and then people are shocked that it took $1,000 out of their account when things go wrong. So just keep those factors in mind. As we go through this, like I say later, we'll look at some better ways of trying to get into the market, get some exposure there without setting ourselves up to be financially destroyed for it. For today, these are going to be kind of our topics. We may take less than 2 hours. We may take more, but it's going to be something that it will depend in part on questions. and I'll try to make it as clear as I can, because today is going to be kind of pivotal in defining what exactly we're doing, what exactly we're looking for, and how we're going to use it. So before I get too far into this, actually, let me just mention one thing to everyone. I did have some problems with the recording yesterday, and so as a result, I'm going to stop the recording a few times today, and we're going to take a couple more breaks today than what we took yesterday. But the reason the recording got so large, Camtasia starts putting they stop the files at 1 gig in size, and these raw recordings are very large. It crashed when I was all done and lost the entire recording from yesterday's session. So essentially what I had to do, I went back through yesterday and redid the session just on a recording. And so the recording, you should have received by now a link to be able to get this downloaded. And so the recording that's there, I did cover everything that we covered yesterday. I worked the questions that were there back into everything, and then we'll get going with that presentation here this morning. We're going to stop every half hour and just save the recording so the file doesn't get over 1 gig. Apparently, when it takes those files and tries to merge them back through, makes a big mess. So the recording that I sent you out, just so you're aware of it, that is a WMV file that'll play in your Windows Media Player. That is a low quality recording, and the difference in size, you downloaded that at around 68 meg. The AVI file, which will be the final file that you get, that is 480 meg. And so just for the day-to-day recording, it's a lot faster for me to render a Windows Media Player file. So day-to-day, I am going to send out a file at the end of the day, but that file is going to be a low-quality recording. So just for you guys, if you're here and you don't want to download it, don't download it, because there will be a full recording at the end that will be the AVI, which will be very, very clear quality. The quality of that will be the same as what is here on my monitor that I'm presenting from. So I wouldn't worry about, like Gary with your question, I wouldn't worry about downloading everything unless you want something specifically from that day. You'll still have the links, so if you wanted to come back and download one of the days, you can. Those links will be available for 14 days, and then they're going to disappear, and it's going to limit you to 1 download per person. But like I say, you'll get the full quality recording at the end. And I did go ahead, I wanted to see how long it took to do it. I did go ahead and put in a working table of contents. It actually didn't take that long. So there is a table of contents on each of these, and then it'll make it very quick and easy at the end to put them all together and get them out to everybody. So, got a couple questions here. We'll get to these questions at the end about the time and sales window, if that's okay, unless you have to leave early. If you have to leave early, let me know and I'll put that up. But for the time and sales properties, we'll put that up at the end of the day. I'll come back and just review through the questions and make sure that everything is, everything has been answered. Tom, same goes for your question, or I guess it's more of a comment about the large S&P charts. And you asked the question, do I ever watch the E-mini from the big contract? And no, I don't. The big contract, there's no volume in it. There's no reason to watch it. And, when you say that this is the large traders, it's not. The large traders aren't trading the big contract anymore. The large traders are trading the E-mini. So it's not, there's nothing really that viable, I guess, about the big contract that makes me want to watch it. When you've got that open outcry contract and it's trading just a few thousand, 3,000-4,000 lots a day, there's no reason for me to care what they're doing. They couldn't move the market 1 tick with that. So they're basically trading one instrument back and forth in that pit. and they can move their little instrument around, but that instrument doesn't necessarily have the impact anymore that it used to have. So, well, let's take a look at this here. The things we're going to discuss today, obviously, you've had a chance to read this. We are going to look at the reversals, and we're going to go through some things that you're going to have every time there is a reversal. You will either be able to say, I don't see it and I don't think it's going to reverse here, or you will be able to look at it and see some of these factors. And so I think you guys will find this beneficial, since that clearly is the preference for your trading. But I would start here with this statement, and you guys might feel this already if you've been watching the markets for any length of time. When you look at the time and sales, it essentially is noise. And I would say throughout the trading day, for most of the day, it's just noise. And to try to trade off of that, we will go through that eventually, because there is always interest in how you would do it if all you could look at was the time and sales. But it does drain you mentally. To me, about 20 minutes, 30 minutes at the most, and I just feel like I've been trading for 14, 15 hours and I'm done. I'm ready for a break. And I've never worked much with people that were able to do it. One of you that is in here has seen Hubert do this, and I think you would probably agree you've seen the same thing. Hubert can do it. Hubert Sinners. Again, it's something that he can't teach it, and very few people can figure it out. And I've experienced the same thing when I've tried to show people. There's not a lot of payoff for all the mental work you put into it, but we'll go through it anyways. So if that's the case, if we're not going to take our trades 100% off the time and sales, then we have to say that at most points, the time and sales is just noise. And I would consider that to be the case unless we're looking at good areas, at good potential points for us to take trades. Now, we looked at this. You guys obviously have some interest, some of you, in continuation moves. And as we talked about with Pete's question, you take a continuation move, and you have to ask on a continuation move, how do you go about getting into a continuation move? I've seen two ways of doing it that were successful. One of it would be, if you feel that the trend is going higher, you're waiting for a pullback and you're going to buy the pullback. Another way of getting into it is saying, if it breaks this prior swing high and continues higher, then I'll let it get me into the trade. You're going to place a stop entry order, and you're just going to come into this on the fly. So there's an interest there, and we want to find areas where this will happen. We've got the breakout, breakdown moves. We see a sideways consolidation or a base. Everybody used to call it a base. Now it seems to be consolidation is the term of choice today. Again, at those kind of points, we're going to see indications on the tape that will give us a clue as to what's about to happen. And it's going to happen very quickly. It's going to require us to be paying attention at that point, and it's going to require us to make quick decisions at that point. But bottom line, the question that we all want to understand is, where do you look to the time and sales when it comes time to make a decision? So I would say in the past, I've defined it this way, and we'll go through what this means. But some of you trade in such a way that you will have simply static points where price is likely to change direction. Some of you will trade in such a way where it's dynamic. It's a dynamic point. And here's what I mean by that. We're going to take a look, first of all, at static price points. And I'm going to do something here. Some of you have seen me talk about this before, but I'm going to do this again because there's many of you that haven't seen it, and I want you just to think about what it implies for our trading. Static price point, we've got numerous things here that many people base their entire trading strategy on. We've got floor pivots, or pivot points, as sometimes they're referred to. And people put a lot of weight on those lines. They got their S1 and their S2 and their R1 and their R2, and they've got the pivot line. And they will base an entire trading strategy on a mathematical calculation that was based on yesterday's high and low, and close. You've got another school of traders who is into a market profile. They like the value area high, the value area low, the point of control, and when they see price start to move, they're looking at any virgin point of control around them as potential targets or as potential reversal points. Short-term traders, we get the short-term traders frequently, what they're going to be looking at, like they take a tick chart, they're looking at the swing highs and the swing lows. Those are going to be areas where the time and sales will be very valuable. For other traders, high of day, low of day. We come up into yesterday's high. That was it yesterday. That was resistance. That was where there were enough sellers to finally overpower the buyers, or at least the buyers gave up. Flip that over for the low side. Is that a valid area to go to the tape? We have to say, yes, that is a valid area to start looking at the tape. Some of you have subscribed for a long period of time to the opening period high and low. And some guys have done that for years for 5-minute opening periods. Some mark off the first hour, some mark off the first 30 minutes, and they expect some type of reversal or activity at those levels. We get the typical support and resistance that we're taking off of a chart, just looking to the left. We've got trend lines, we've got channels. But when we look at these levels, the reason that we're calling these a static level, there's something that each of these things has in common. You can look at this in advance, you can put an alarm on it, and then you can quit watching. Now, if we can do that, in some ways, that allows us to come in and spend 5 minutes or 10 minutes at the beginning of the day, and we sit down and we build ourselves our little action plan for the day, and we say, these are the levels that I'm interested in. I'm going to put an alert there, I'm going to put a line there, whatever we use, and we're going to just simply wait for price to get there, and we're going to look at the reaction. Now, is that a viable trading strategy? I would say yes, it is. I've done that for many years using some of those very things. Simply waiting for price to get to a specific level that interests me, and at that point, I'm watching the tape, I'm watching the price action, and now I'm going to decide whether I feel that it's a reversal, whether I think that it's going through. And I will either take the trade or not based on what I see on the time and sales. So I have to say, yes, that works. Now, if that's the case, we could take what you guys have already been doing, perhaps for years in some cases, and all you simply have to do is refine it by using the tape to confirm that entry or to blow it off and say, nope, it's not working right now. We're going to talk about that more when we get into the management part of things. But just in brief, when we talk about a trade and we're getting ready to get into an entry on a trade, there may be a point where it's not doing what we expected it to do, or it's not doing what we wanted to see in order to confirm our trade. And yet on a chart, technically it still hasn't violated it to the point that we're going to go the other direction, and it hasn't violated it to the point where we just blow the trade off and say, nope, can't do it. So, we can look at these points, we can give a little leeway there. I remember an analogy when I first started trading. It was a firm, Pristine. Many of you have heard of it. They've been around for, 15, 16 years teaching people how to trade. One of the things that I always appreciated from their teaching, in spite of the fact that most of it didn't work too well, they did a lot of work with moving average, and they always liked the 200-period moving average, and that was where you took the majority of your intraday trades on. They always said it's like a rubber band. It can stretch a little bit. So if it went 1 tick through or 3 ticks through, it didn't violate the trade setup completely. They went ahead and watched the candle pattern form, let that play out long enough to know whether it was still going to go ahead and give them their confirmation. And their confirmation was based at that point 100% on price action. And so we have to say the same thing with any of these lines. And bottom line, what you're going to have to do as traders is you have to look at the instrument you decide to trade and say, how much room do I have to give this? Does it need to be 3-4 ticks if you're trading the S&P? And at that point, if it goes on beyond that, it's gone through to the point that I no longer want to enter it? Or do you say, I'm trading crude 15 ticks through? It still would be a good trade for me. You start looking at how far it carries through day by day. You build a filling for that particular instrument, and then you're able to come in and trade that and repeat that time after time. You'll be able to be successful with this type of strategy based on what you're already doing. You just are using the tape to filter it now. So when we look at the static price points, these are things that in advance, and usually far in advance, most of them, we could put those lines there, put those alerts there. So how does that differ from a dynamic price point? Well, when I talk about a dynamic price point, I'm talking about something that's moving, it's alive, it's moving up and down. We can't look out way into the future 2 hours and say it's here. It's something that frequently unfolds in real time, and it's reflected because of what the market structure of the day is. Now, when I refer to the market structure, I'm talking about the tempo of the day, and it's down on the day. This is the way that it's setting up and structuring. It's a slow tempo. It's grinding to the downside and so forth. And we could come in and say there are some ways of looking at this that we can't predict out into the future too far, but we know that there will still be reactions there. Well, again, we want to figure out, are there areas like this that you're already using? Are there areas like this that can be spotted? Now, when I look at that, I would say yes, there are some of these points that you guys are currently using right now. What are they? Anybody trade a moving average? Anybody trade price action, where they're taking a cue specifically from one candle moving over the top of another candle? Anybody put a Keltner band out there, a linear regression channel, Bollinger Bands? You start thinking about that. Those, at best, you're going to see just a few minutes of heads up when it comes into that. If you're trading a moving average crossover, maybe that's a little different than somebody that's trading it as support and resistance. Pristine strategy, which worked very well, and there's still some validity to it in many degrees today. You're just simply waiting for price where it's been in an uptrend to come down into a moving average. And when it comes down into that 20-period moving average, if it's rising, and they always had 75 filters to blow the trade off, but essentially they would wait for it to come down into that moving average. They would then view that as a support area, and when it traded higher on price action, they would go long. So you have to say at any of these points, if you were looking at it to contain price or to stall price or to reverse price, that would be a valid point to come in and start looking at your time and sales. So the problem that we run into is this. If we're using a moving average or we're using price action of a candle, we're using a Bollinger Band or a Keltner channel or a linear regression channel, in some ways, if we just use that by itself, it essentially would put you behind the game. You're going to be late in seeing a signal because you have to wait for the 5-minute candle to close. You have to wait for the indicator to roll over. Whatever happens, you're going to be getting an entry that frequently is 4, 5, 6 ticks in a market like the S&P, or maybe 10 or 15 ticks behind in a market like crude. We got a question here, which I will address here. What did they consider price action? They primarily traded 5-minute candles for all intraday trading. and they wanted to see a 60-minute chart in an uptrend, and then when the 5-minute had a pullback to support level, they would wait until that final candle, that pulled back into the moving average. Their trade signal was when you traded above that low candle. In other words, you would have 3-4 candles down. When it made that low candle, you had some bottoming tails on it. When it traded above the prior candle, that was their signal to go long. They didn't have to close there, but they did. They had to see that at least trade above the prior candle. So in that sense, it was pure price action trading for the entry signal, but it was the support and resistance came off a 20-period moving average on a 5-minute chart. So the lagging tools, I've always said, if you want fast confirmation, when you think you're at a good price level, there is nothing on your platform that will plot or react or change faster than your time and sales. We talked about that yesterday. Your time and sales will still be running when the entire platform locks up. The time and sales will keep streaming in. So, to me, the time and sales then is something that we can use at any point in there in that trade. It doesn't matter whether we're still using our indicator. If you're using one, don't take what we talk about to say you have to quit. If you're still using a straight price action, it doesn't mean you have to quit. You can still take 90% of what you're doing and then go to your time and sales and use that time and sales to come in and either give you the confirmation to take the trade, and you're doing this with minimal confirmation. The result is you usually get a better price point, or it's going to blow the trade off and say, no, this is not the time. So I'm going to stop here for 2 minutes. We've got half an hour behind us. I'm going to just stop our recording and then restart that. It takes just a minute for that to produce the little video file. So I will be back in 2 minutes. Okay, so we're back. I appreciate your patience in doing this, but I just want to make sure that I don't have to talk through the whole thing again. 7 hours a day of talking, I'm going to lose my voice. So that file, just for those that are interested, when they record these, I'm recording AVIs at a very high frame rate, and the 27 minutes that we had was just shy of 1 gig. And then when I edit those down into the final files, they actually end up smaller, but it really chews up some CPU and memory when you're trying to put them back together. And I was putting the file back together last night, and the thing just crashed, and the whole recording was gone. So couldn't be retrieved because it was still stored in the temp folder at that point, and it had just been deleted out and cleaned out. So anyways, so let's continue here. We've got the question, how can time and sales help when we're trading a setup from an indicator or from straight price action? These are things that some of you have heard me say before, but these are the things that we have to pay attention to when we're looking at the time and sales. I don't know that they're in any particular order of importance. I'll tell you when I'm done which is most important to me, but these are the things that we will be trying to take from the tape. Now, a guy may look at this and say, I can't track all this stuff. It's too much for me. And you don't have to track all of it. You may take part of it. You may take one of these things and really focus on that. You may take 2 of these things and really focus on that and build your trading strategy around it, and it can still be very effective that way. So let's talk about what we're referring to then when we talk about speed. You guys, obviously, if you open up a time and sales of the S&P E-mini, and you open up a time and sales of GC, which is gold, you can tell the difference in speed. One of them is blurring by where you can't hardly focus on the price or the size, and the other one you could study on the same height of time and sales. You could study the last 15 minutes and see where all the prints were in the last 15 minutes. when we start watching the speed, there's several reasons that this is important. The speed that the tape goes by, I could tell you just watching the speed when we're coming into a news release, and I have found myself on many occasions in many trades where I forgot about a news release that was coming up, and because of the change in speed, in my mind, I immediately said something just came out. Um, I missed a news release. If I look at the clock instantly, and it's 8 o'clock, and I'm going, crap, totally forgot to look at what releases were out today, but I could see it change on the speed. I would suggest that within 30 to 40 seconds of the open, I usually have a pretty good feel for whether we're going to have a sideways day, like a grinding type of day, or a real volatile, big range up and down and whipping around kind of day. And I would get that impression primarily from the speed and from watching open after open after open after open for years. And I got a feel for the speed, and I can look at the speed of that tape and go, that is slow. It's running slow today. Yes, it just sped up based on what it was doing at the pre-market, but it's slow today based on fast days. It's slow today based on days where price was explosive and it was moving back and forth in 15-point ranges. It is so slow that it feels like I'm already in the doldrums, and I'm thinking this 30 seconds in, I expect that day to be kind of a slow grind. Doesn't mean it won't move 20 points by the end of the day, but in my mind, I'm already gearing myself to say, I like bigger targets. I like to get a runner, and if I could get a runner and just have one trade for the day and I'm still in that position 15, 18 points later, that would be ideal for me. So when I see that type of lackluster speed, it's just the pace is very slow of the prints coming in, it says to me this is not my kind of day. And I know that 30 seconds in. The speed of the tape, there are other factors that we can take just based on the speed of the tape. And, we think about price levels of interest. Everybody talks about the large traders that are coming in trying to run stops, trying to probe price levels. And you can see the excitement. You can see the tape speed up and slow down. And you can see that long before anything shows up on the chart. If you've been watching for 20 minutes, and during that 20-minute period, at any given point, you could look back and you could read the hour, the minute, the second, you could read the full price, you could read the lot size, and you could go down your time and sales, and you could say, okay, well, those 4 prints came in together with the same timestamp, and these 2 did. It's a slow tape. And it's not likely that the market is going to be moving much. It's not likely that it's going anywhere. It's just drifting along. It's chopping along sideways. And so it's very important because, we take trades, we're looking at a reversal, and there's no speed on the tape. There's no, I would say there's no gusto. There's nothing happening there. This may not be the reversal that we're looking for that takes us to the high of day. So it is important to start gauging that speed. And what I prefer to see, this is just my own preference for my own personal trading, I would like to see the tape going by fast enough that all I can do is focus my eye on the decimal point in the price. And all I want to see is the last digit to the left of the decimal point, the first digit to the right of the decimal point. And I want it to blur by so fast that that's all I can see. That's what I prefer to see. Those are the type of conditions that I prefer to trade in because there are opinions there. There is buying and selling. They are trying to push this one direction. And that suits the trades that I prefer. I would like it going by so fast that I can see in the size column whether it's single digit or double digit or triple digit, but that I can't really focus on the numbers much. You may prefer something slower that's not that volatile, you're going to have to gain an understanding of what is good for you, what's good for your trading setup, but that is a very important factor. Now, I want to compare this back to something some of you may be familiar with. In fact, I know, make sure you're in here. Yeah. Want to make sure that you guys kind of understand where this goes back, that there is a definite and profound basis for this speed of the tape being important. Some of you I know have used and are using Pit Audio, and some of you have never heard of it, and some of you have heard of it and have never used it. But Pit Audio, for years, there have been what are called squawk services, and they have a microphone suspended above the pit, above the S&P pit, and they have a commenter that sits up above the pit, and he calls out the bid and the ask. He calls out the fist fights and the the scratching and the wrestling that goes on, and everything that's happening there. And as he looks down into that, he's got a nice overview of the action, and understanding their hand signals, he can give a good overview of what was going on in the pit. You could subscribe to this, and you could have his commentary, and then on his commentary, you would hear a little bit of the background noise of the pit. Or you could hear a separate feed, which was just the microphone of the pit. Everyone that I have ever known that successfully used that understood that, and I'm talking about off-floor traders. They came off the floor, went to the screen. They would never, ever listen to Ben comment on what was going on in the pit. They listened to the noise of the pit. And what they looked for, if they were in a position and they heard that explosion in sound where everything got just frantic and screaming and yelling and everybody's trying to execute, that was typically when they would start exiting their trades. Now, there's a direct correlation to what we see on the tape. When we see that absolute explosion that comes in, and we're going to talk more about this in a minute, but when we see that absolute explosion, it's indicative either of a move beginning or a move ending. And that's what experienced traders that have been in the pit, that's what they want from Pit Audio. They know that explosion in the pit is either going to be a reversal point, or if it's been quiet and it hasn't been moving, they know that explosion is going to be more indicative of a breakout. Well, the Pit Audio is still available, and the problem with it is that the pit doesn't have the impact that it used to. But it's interesting to note that it's the same thing. It's that frantic activity that will either kick a move off or stop a move in its tracks. So the speed of the tape and being able to judge the speed of the tape is very critical. And at the end of our session, I'm going to go through some drills to try to help improve the way that we can track this. It does take a little bit of practice. The size of the prints is what I'm referring to there when we see these executions coming through. Now, we laid the groundwork for this yesterday by talking about what the exchange has done and the way that they're presenting the prints to us. 1 year ago, you would have simply looked for large market orders coming onto the tape. And if you saw 2 or 3 large orders, 300, 400 lot orders, and this was happening at a point where you expected a turn, that could be, in many markets, all the confirmation you needed. You get 1 or 2 large orders. Well, because they've changed the way those orders are presented to us now, we have to kind of gauge size more on the basis of a flurry of prints coming in. So we see half our screen or 3/4 of our screen drop on the time and sales that's unfiltered, and we see 15 or 20 drop into place all at the same time stamp on the filtered size. Now we look at that and say, there is some size. There was a large market order. We can quickly, we know it was half our screen, and we've got 100 lines on our screen. We know, okay, that was a minimum of 50 lots. We scan our eye down it. Most of them were 7s, 8s, 9s, and 10s. we could look at that and say, okay, there was 800-900 lot market order. So it's a little different than it used to be, but it is an important factor on the tape. And I have always felt you can look for two things. You can look for what the small traders are doing, and then you can trade against them. Or you can look for what the large traders are doing, and you can trade with them. If you do one, you just about automatically are doing the other. I think personally it's easier to look for size than it is to look for the small traders. But that is an important factor that we're going to pick up off of our tape. Now we talk about control, and when I talk about control, you will frequently watch the tape, and I encourage people to look at this and even to go back and look at it on replay. If you have your replay recorder on, or if you have version 7, you can go back and download a replay and watch the tape again. When you watch a move that is it's running hard, you can tell definitely without even being able, you don't even have to focus on the tape, but just having it in your peripheral vision, you can tell who is in control. You will see 30 or 40 red prints for every 2 green prints, and it will go and go and go and go with that being the case. And you may come up to a point, and this may be one of the levels that you've chosen. It may be a pivot point, it may be support and resistance, it may be a moving average, but you will reach a point where price has either gotten dear enough that sellers come onto it, or it will get cheap enough that buyers will come into it, and you will see the change in control. Now you got to bear in mind that takes some observation to get comfortable with. You're going to have red, green, green, red, green, red, but there will be periods, and these are going to be the periods where price is moving and the market is active. You will see very clearly that it is one-sided market. You can identify that, again, peripheral vision. You don't have to see the size. You don't have to see the timestamp. You can tell it is all red, and it's been all red for 10, 15, 20 minutes. Well, that doesn't necessarily do you a lot of good getting into a short, but it can tell you a couple things that are beneficial. Let's say that you've watched this for 20 minutes sell-off, and the sellers absolutely have grabbed that instrument and they're driving it into the floor. And all of a sudden you come into a level and you see big size start buying. And I always say if it's been a sell-off, the first flurry, or if it's been a rally, it would work either direction. The first flurry that happens is very likely some profit taking by guys that are smart. Second flurry that happens at that price level would usually, to me, be, I would consider that initiation of new trades. So we will reach a point where all of a sudden you can sense that the sellers are starting to lose their control. That is very important to me, and you don't see that all the time. The reason you don't see that all the time is that many times the market is two-sided. There's just as many opinionated buyers as there are opinionated sellers. They are equally aggressive in placing market orders. And as you're sitting there watching it, you got 15 red come through, and then 15 green, and then 15 red, and 15 green. And when that's the case, all you can do is file that away. That's information that you now know that you didn't know a minute ago. So you're now looking at this saying, it's very two-sided. We don't know who's going to win. We could just end up in a range. It can prevent you from getting into a trade at that point, thinking that you're going to get a big runner because you realize that it's very two-sided. To me, the best thing that you can find is the period of time where one side has been seriously in control and they lose that control. Yeah, maybe you guys could just type out here what that would be indicating. Your sellers have been completely in control 15, 20 minutes, and now on the tape you see them starting to lose that control. You see the green prints getting more and more aggressive. The market buyers are getting more and more aggressive. What do you see happening? Okay, exactly. Karen's first one out here, reversal coming. Several comments are coming in. When we see that reversal, we have to say, and I'm going to put a chart up in a minute, we have to say on the chart, we're not going to buy into that picture very quickly. But on the tape, when we see that change in control, that is the fastest, quickest indication that you have that there's going to be a reversal. So if you guys like reversals, let's put the 2 and 2 together. What do we do with it? Wouldn't that imply that we wait for that to come into our level where we think, okay, this could be a reversal point? There's a very logical reason to view this as a potential reversal point. We've watched the sellers in control. So now we've got these two things in alignment. What do we need in order to take the trade? And we see that change in control. When there's been that change, that is, to me, the best difference. Now, how could a continuation trader be watching the same tape and the same chart and come up with a completely different trade where he's going to short it? Let's take the same scenario we're discussing. Price is in a downtrend. They've been selling it for 30 minutes. They come down into a level where buyers start stepping in. We see the green print start coming in on the tape, and they get more and more aggressive. The market buyers are coming in more and more aggressive, and price starts to move up. Where does the continuation trader start watching that tape? See, he's looking at that, and he sees them take control away from the sellers, and now he's simply waiting for the sellers to come back into the tape with the aggression that they had earlier. And so as he watches that rally back up, he may be looking at a fib retracement, and that's going to be his price level. He's saying, I want to get this up here to the 50-60% retracement level, and then I want to see that change in control again, where all of a sudden we've got aggressive buyers coming back onto this instrument. Did I say buyers? Aggressive sellers coming back onto this instrument. They're going to take control back from the buyers, and now we're going to get our continuation to the downside. So for each trading strategy, they can watch the same tape, and they can take what they need from it. Now the guy, and let's just think about this in terms of filtering out losing trades. The guy that's watching it for a reversal, it may get to his price level, and he cannot see any evidence that the buyers are taking control from the sellers. What does he do? He passes on the trade. And if he would have just entered the trade 100% based on the fact that it was to yesterday's low, it may have worked out, it may not have worked out. But if he gets to that level and he actually sees that the sellers are trying even harder, what do? You blow that trade off. You want no part of that. The continuation trader, he watches that coming back up into his Fibonacci retracement zone that he's interested in, and he sees that the sellers have tapered off, and he gets up into that retracement zone, and he sees that the buyers are aggressive, and he sees a couple feeble prints come through on the sell side, and the buyers just keep buying and keep buying and keep buying. Is he looks at that and says, this is a chart setup that I like, and it's very successful for me, but at this point, sellers are not stepping in and trying to take control. And so he blows that trade off and says, not here. Now, it doesn't mean that he can't enter. It may go up another point, and then we see the sellers coming into it. If he does, he may say it still didn't violate the overall chart pattern because we didn't come up and make a new high where I think, now our trend is changing. So he may still come into that. He may say, now I've got to move my target. The target's going to be before the prior low because it rallied higher than I thought or so forth. But he can still, just by watching the control on the tape, he can still come in there, make a good decision, filter that trade out, and improve his win-loss ratio. He can take a 50-50 setup like a Fibonacci, and by filtering it, he may turn it into a 60-40 win-loss ratio. Not changing anything, just watching the tape, seeing who takes control where. So if you're a patient trader, I would say this is probably the best thing to watch. You're going to watch out for the situations where it's very mixed, and if it's very mixed, you have to realize that it's probably a scalping market, and if you know how to scalp, you scalp. If you see that one side is firmly in control, then you can either trade that for reversals or you can trade that for continuations. You're just going to look at that control. And this is what I meant earlier when I was saying we may decide to only focus on one aspect of this and make that our confirmation. It doesn't mean that we have to see the speed change and the size change and the control change and the results and the interest. We may just take one thing and say that is very dear to my trading plan. I can work that right in with what I do right now and make it happen. So I would say control to me, the trades that I like the best, and this is where I would be willing typically to go from a 20 lot trade to a 50 lot trade, would be based on changes in control. When one side is clearly in control and I see them lose control, that's where I'm really willing to step up my size. I'm putting that out there for your reference as to what my personal preferences are. Doesn't mean that's going to be the right thing for you, but that's what works for me. Now, a couple questions, and Tom, I kind of touched on this, I guess, unintentionally. You asked, how can we spot follow-through? Well, you think about follow-through, if we were talking about this strategy or this scenario earlier, we've got a sell-off, sellers have been in control. We come down into an area where it looks like it's going to bounce. How do you spot follow-through to that? You see the tape speed up with sellers. You see the size pick up. Big sellers coming into it at that low. You see the little attempt to wrest control from the sellers, and it's immediately met by big, huge size coming in selling. What does that tell you? This thing is going lower. They are not interested in giving the bulls a chance at this level. They're pushing the pedal to the metal, and they're getting even more aggressive. And we have to stop and say, why is that important? The reason that's important is you don't find very many smart traders, and I shouldn't say smart traders. Let's define it as smart money because we don't want to insult someone's intelligence. You don't find smart money selling lows, and you don't find smart money buying highs unless they know that it's going higher. They're very confident that it's going higher. They're intending to push it higher. They're intending to push it lower. So if we're looking for follow-through, we're looking for the big boys to be doing something that big boys don't do. And that is to come down there at a dead low up against support, and that's where they start initiating big size. That should answer that sufficiently on that basis. And Karen, your comment that the hesitation when you're waiting for some confirmation and then because of hesitating missing your entry, that is to me one of the biggest problems that traders face. You know, when we look at the really big issues, I think it's moving your stop further and further away. You know, letting something that would have been a $100 loss turn into a $5,000 loss. It's the hesitation, and you know in your gut, you're sitting there looking at this going, I felt it, I smelled it, I could taste it, and I was scared to pull the trigger, and now it's down where I would have already been taken off my first lot, and I don't know whether I should still enter or not. And it's frustrating, it damages you emotionally. And that's where I've faced that. I've been through the same thing that you're expressing here. You hesitate, you miss the entry, you kick yourself. The way that I dealt with it was to say, I just need to see minimal confirmation on the tape. And if I can get just a minimal confirmation there, that's good enough for me. I'm going to take that trade. By doing that, will you get stopped out? Yes, you will. And you have to be able to realize, as a trader, 3 or 4 trades out of 10 are going to stop out, and it doesn't matter. Brian, the comment that Karen made, she said that what she has found is that she might hesitate waiting for some type of confirmation, and by hesitating, I have missed the entry. Now, where Karen's coming from with this, I'm assuming, Karen, you're talking your confirmation off of charts or confirmation off of some of your tools that you've developed for yourself. You're waiting for that confirmation there, and then because of that hesitation, it's moved far enough, that you're looking at it going, don't know if I can still do it here. And Karen, do you mind if I mention the market you trade? I know you're planning on putting up charts anyways. Okay. We're talking about crude, and for anybody that's traded crude, and Karen, has got some very good things going with crude. But anybody that's traded crude will realize that it can put 15, 20 ticks down faster than the S&P can move too. And if you wait and you hesitate, frequently you're already so far away. Now you're going, stink. I was going to do this with a 12 tick stop, and now I need 32, and I still see it going lower, but I don't want to give it a 32 tick stop at $10 a tick. So it is a very fast moving. You really have to be kind of a cast iron stomach to come in there and trade crude. You feel like you're stepping in front of a freight train. It can be a very dangerous market to trade, but it can also be a very lucrative market to trade. And for people that don't like to sit there and grind for an hour on the S&P, the nice thing is you're right or you're wrong, and you usually know that pretty quick. You don't usually have to sit there for 45 minutes to figure out that you're going to get stopped out. So, well, let's stop here for a moment. We've got another half hour behind us. I'm going to reset this tape and save that, and then we'll come back to points number 4 and 5, which would be the results and the interest there. So I'll be back in about 2 minutes, as fast as this can save this file. Okay, so back again. Just we've got a couple that came in late, and just for your reference, guys, the ones that came in late, the entire recording yesterday got lost, and I went ahead and just redid the presentation and worked everybody's questions in and re-recorded it. But what's happening with these files, it's just the way Camtasia handles things. It records an extremely large file into temporary memory. And then when you finish up your recording and turn it off, it takes that and processes that file back into the actual AVI video. And it apparently, what I found out happened after an hour of fighting it. It will take these and put them in 1 gig chunks, and then when it tries to reassemble all of these 1 gig chunks of video that's in temp memory, it can crash. And by having nearly 3 hours recorded yesterday, it ultimately just crashed, and all of the stuff that was stored in temp never got processed into AVI files, and it was something that couldn't be retrieved. So I'm just stopping every 30 minutes so that I can limit that. At 30 minutes, it will take just right at 1 gig to record or cover 30 minutes. So where I'm stopping, I'm basically just processing that 1 gig video out of temp memory into an AVI video and then saving that video. So that's why we're kind of hesitating and stopping, and we're going to have to just do that throughout the rest of the presentation. So getting back to the presentation, we got a comment from Karen, and this is exactly correct. She says, what will happen, and we're speaking again of crude, what will happen is that when you revisit the same price where you were thinking about your original entry, they will very frequently run it back through there. So you get a chance, you've got a trade, you hesitate, you miss the trade. When it comes back again, you're scared to touch it again, because it's very, very possible that they're going to go through. And so it's demoralizing. You sit there and you track it and you watch it and you see it and you hesitate and you don't get in and you miss the trade. You beat yourself up, and then that can lead to making more stupid mistakes, or ultimately it makes you feel like giving up as a trader because you can't pull the trigger when you get there. So again, when we can start focusing on some of these things on the tape, hopefully that will help individuals to get that that speedy confirmation. You obviously have to have a method you trust. This is something that's hard to back test. You have to almost do it in real time going forward, because you don't have a back test engine that can run the tape and interpret what you would interpret out of the tape. So you kind of build this as you go forward, and then as fast as you can start trusting that, that's where you're going to implement it. That's one of the reasons why I've encouraged individuals to take their existing setups that they're already comfortable, they already trust the setup, and that way it's minimal things have to change in order to implement the tape into it. If you say, I'm going to throw out everything I do and I'm going to go look at Joel's chart and I'm going to look at his tape, well, you may be months trying to get this thing figured out. So let's talk about the other two factors on the tape. Results. What am I referring to here? Let's imagine a scenario where you've rallied up and you come up into a high, and as you come up into this high, you see a tremendous amount of selling coming into it. And let's say then that you chicken out and you hesitate and you don't get in the trade, and big size is just flooding this thing, but they can't push it back 2 or 3 ticks. And you watch, let's say we're watching the S&P, just so you can compare scale. We're watching the S&P, and you watch literally thousands of sell market orders hit this, and they can't knock it back 2 or 3 ticks. And we have seen enough come through to say this is not profit taking. This is initiation of new trades. And so at times when we hesitate, we get lucky and we find something like this. So now we're watching it going, what in the world's going on with this? And so we might sit there for 6, 8, 10 minutes, and over the course of that time, we may see 30, 40,000 sell market orders go by on the tape, and they can't push it back more than 4 or 5 ticks. What does that tell you? See, they cannot get anything for all the size they're throwing at it. They're getting no results. So they're trying as best they can to come in and reverse this market, to knock it back down, and somebody so big, that they weren't anticipating them being there, but somebody very big has stepped up and they are absorbing all of that order. So we sit there and think at that point, then, couldn't we say that that's really, it's about all we can compare it to is divergence. They cannot get any results for all the size. You know that normally 40,000 coming in at the market to sell is going to knock price back 5, 6 points. And now all of a sudden they can't knock it back 5, 6 ticks. Can that be an indication to us that we need to take that where it is 5, 6 ticks down and consider going long? I have watched traders who would do this deliberately, and they would hold a level and buy and buy and buy and buy a level, and they would allow it to come back into them. They would actually try to allow the appearance of a breakdown, and they would allow the appearance of a breakdown because they were trying to get 1, 2 lot guys into going short. They wanted more to buy, and so they would back it up. After doing this, they would back it up another 2 or 3 ticks, and you would see another flood of 1 lot sell orders hit the tape, and then all of a sudden they would sweep 3, 4, 5 levels and literally take out 15, 20,000 contracts and just go blazing right through the high. So if we spot something like that, that can be a very beneficial thing to consider going for the breakout. Now, Is this something that I personally would sit there and watch for? Would I deliberately hold off all entries and just sit there and watch for them to get no results for their size? And I would say no, personally, I would not make that my strategy. You don't see it as often. But where I see this is frequently when you miss an entry and you're sitting there cussing yourself and you realize it didn't go anywhere. And you start to watch and you watch and watch and watch. All of a sudden it creates a situation where you could take a fairly low risk trade from the standpoint of dollar risk. You don't have to risk a whole lot at that point to find out whether or not you're wrong. And the potential gain, not only can you get the run to the high, but you can get the run through the high. And if they were able to sucker in 15, 20,000 shorts, those shorts are going to stop out within a tick or two of going over the high. So if you can get through that, you may very quickly pick up a little 2-3 point explosion and out where you only needed to risk, a point or 5 or 6 ticks on the S&P to get that. You can get yourself a 2-to-1 or 3-to-1, when you're looking at the potential reward. So, like I say, I wouldn't personally make it my only strategy, but if you recognize it, it's definitely good to pay attention and decide whether you want to trade along or not. The final point here, the interest. This is probably correlated fairly closely to control. But when I think about interest, you can tell at times, let's say on a rally, you can tell that there is just absolutely no interest in selling that. You guys have probably seen that move that just it runs from one side of the range to the other side of the range. It goes from low of day all the way up, all the way through the entire first hour and a half trading session, and it does it in one continuous move, and you don't ever find any interest from sellers. You'll get 2 or 3 prints, and then the whole screen is green. 2 or 3 prints, the whole screen is green. 2 or 3 prints. And at some point, again, you will start to see some interest or some nibbling at the sell side. So it's very closely related to control, but it is something that's important for us. If we see that there is absolutely no interest, there can be some specific strategies for entering on that basis. I have showed some of you what I refer to with it in this type of a scenario is basically coming in on a tick chart, correlating this back to a tick chart. And if we correlated that back to a tick chart, we may be looking literally for just a 2-tick pullback. And again, we're talking something like the S&P where it's not going to wiggle like the NQ would or the crude or the Dow, but something where literally there is so little interest on the sell side that there's a hesitation, teeny little bit of selling, you get a 2-tick pullback, and then the buyers are right back on it. If you're doing that, one thing a guy can do is if you remember the number where it's stalled, and you remember this from looking at the tape, or you look at your tick chart, I personally don't like stop entry orders, but that would be the type of situation where I would use a stop entry order, and you put that just a tick over where it's stalled, and the next push through, you're in the trade, and if it doesn't push through, you're not. You don't get in. But again, at some point on any rally, you will start to draw interest from sellers. At some point on any sell-off, you will start to draw interest from buyers. So as we're doing this, these are the critical factors on the tape, and you don't have to master all of them. You don't have to master 4 of them or 3 of them. You can take one of them and make your whole confirmation for your existing setup, and you can improve your win-loss ratio by that. Now, I've been asked before, which is the most important to me? To me personally, for my trading, I like speed, and secondly would be the control. I don't pay as much attention in my own personal trading to the size. I'm not fixated on it. Yes, I want to see some size come in, and that's changed, as I mentioned yesterday, from October of last year, where I used to look for 1 or 2 large orders. Now I look for a flurry where I get 15 to 20 that just drop into place instantly, and I can see that drop in on my peripheral vision. I'm not necessarily 100% focused, adding it all up in my head. I probably do that subliminally to a degree, or I shouldn't say subliminally, but subconsciously. I've always in my head calculated very quickly what's there just based on the size, and it's not that I wouldn't put my pinky finger on the line and say I could tell you within 5 lots what was there, but on a 2,000 lot surge, I think I could consistently tell you within 100 what's there. So I'm not fixated on it, but the speed and the control to me are the ones that I personally prefer. Doesn't mean that will work best with your platform or with your not platform, but with your setup. But this is just the way that I would approach it, just for disclosure here. Well, the next section here, and actually before I leave this screen, if anybody has questions about any of these 5 items, go ahead and throw it out. If you have a question, just type a yes and hit enter, and I'll wait for you to get your question asked. Otherwise, I'll keep going if nobody puts a yes out there. Okay, so going, gone. We'll close that out. Oh, we got a question. A question about speed. Go ahead, Karen. While she gets that question ready, just in the future, if I ask if there's questions, maybe the fastest thing is just put a Y or put a Q for question, and that way I'll wait and allow you guys time to type your question up. So, but I'm going to just pause here for a second, and wait for her question. Andrew asks, will you be going through some examples? Yes, we're going to try to do some live trading, and we're going to look for these things when we're doing the live trading. So if I cannot do this, let's just say that we get to next week and the market is lousy and we're not able to see some of these things. What I will do for you guys is I will make available to you a little archive of trades, and I will clearly label what we're seeing. If does that seem reasonable to everybody? If we can see it, we'll pull it up and look at it and see it. But if not, I will take some recorded examples of each one of these things and give you just a little 6-8 minute video to watch, and that way you can replay it several times. So I'm going to make a note to myself here to do that real quick. So. And what I'll do is I'll make those available to you guys on my screencast account. And well, actually, I'll tell you what I'll do. I'll put those on the recording. When I do the final recording, I'll just index that into the recording and put them right there with it. Okay, so Karen's comment here, sometimes the orders are coming so fast that it is hard to get a handle on what is happening until it slows back down. And can you cover that at some point? You know, that is, it's very true. And I think, Karen, in some ways, tape has, or crude has one of the weirder order flows. And I was kind of surprised to see that they really don't have that much bot activity in there in crude, because it definitely can have a strange order flow. For the amount of ticks, or I should say, you know, the actual executions that go through, I would expect it to be doing 1 million contracts a day. But you know, I guess maybe in some ways that's just an artifact of having the majority of trades be 1 lot trades. You don't see a lot of big trades there. So they can come in very fast, and I'm going to go through some drills to try to help this. I want this to make it where it can be second nature. I kind of came to the realization, looking at what I do with tape, that in many ways a lot of it is so automatic. I don't consciously even think about it. It's just there. I've been doing it for 5, 6, 7 years. I just react to it. It's there. I don't even think about it. And I think you guys have helped me, because when someone's asking questions, I have to come back through and find a way to put that into simple terms of what I'm actually doing that I don't even realize I'm doing. But I will go through some drills that will kind of help with that, Karen. A couple other comments here too that Karen made in looking at different markets. I will do that because the character of the markets is so different that some markets have different aspects of this, and so to record some trades and to record some of this type of behavior, it will be on a few different markets. So we'll definitely make that available. In fact, I'll tell you what I will do, guys. If you don't mind waiting an extra day or two, I'm going to continue just posting up a low-quality version each day. But if you guys don't mind waiting an extra couple days when we're done with this, I will go through some existing recorded trades that I have, and I will put in some call-outs and relabel some stuff. It will take me a little bit of time to get it edited together. But as opposed to making this contingent on finding something next week in live trading, I will just put that in there, period. It will be valuable for you to have, and that way it will be right in there in your recording, one way or the other. So you'll have your daily recording, and then the week after our presentation, I'm only going to be in town a couple days. I was planning on just editing that and getting the whole thing out real quickly. But if you don't mind waiting a few days for the final thing, I will take those trades and do it into the final edit. So, and if anybody wants it more quickly, I can put it together without that and send it to you, but I would prefer just to do it as one piece with one table of contents. So just email me if you want the high quality recording more quickly. The low quality recording will still be sufficient because we're not doing a lot of high speed or movement at this point. So, but that will definitely give you guys some value out of things. Let's continue here with the presentation where we sit. And I've got the question, what happens on the tape when price reverses? Now we've discussed these elements that are critical: the speed, the size, the control, the results, whether they're showing interest in it. But we're going to take a trade and a hypothetical trade, and we're going to say, here's our scenario. We're looking for reversals. Most of us prefer that anyways. And now we want to ask, how can we identify that? How can we make this work? So here's a scenario, and I've pre-labeled some of this just for the purpose of the next few minutes of discussion. But I would say this. Can you guys see my my cursor? Okay. Actually, I'm going to try one thing. Can you guys see, you can see a blue circle there? Okay, and everything's recording, so let me just, I will just use the markers on this and the arrows on this because that will make it a little easier for you to understand what I'm talking about with this setup. Where we're going to be talking about is this move up here. We've had a move that's running up. We see a little bit of selling. You can see this on the chart. You can tell there was a little bit of selling came into it. It ran up again, and sellers hit it again. So this is the scenario that we're going to talk about in trying to pick some kind of a reversal on this. Now, this could be a scalper. This could be someone that's trying for 4 or 5 points. But here's what I want to make clear with this. I don't care what instrument it is. I don't care what the price is. We're looking at a general price pattern where it's ran up into an area, and as it comes up into that area, we're trying to identify it as a potential reversal. So if that's the case, I would say this area right in here, for a chart reader, that would be an area that would catch your attention, because you had a pullback, and you rallied again, and you had a double top, And by the time that price got down here, it's now evident that that was at least a short-term double top up here. And so when you come in at that point and you break this level, that would be, for many people, the first indication that you've got a reversal. So let's think about this for a minute, and we're going to analyze this purely from a price action standpoint. Two ways that I would say a guy can trade this type of stuff. One of them is just to have, right here at this level, you're going to have a stop order sitting there, just a sell stop. And you're going to take that on the fact, and you're going to say, this is price action. It broke that prior low, and I'm going to enter here, and I'm going to put my stop above this high right here. That would be a typical reaction for many price action traders. The second type of price action trader is he's going to come in and he's going to allow this swing low or this pivot to break. And when price rallies back up into it, he's going to try to get short right in here. And he may just put a short out there. He may put a limit out there and let it hit him. He may watch for some type of confirmation. He may look for a topping tail on the candle, or you name it. People will look for various types of confirmation. He may do this on the basis of a fib retracement, but he's not going to take this on the fly right here at this point. He's going to let it break, and he's going to let it rally back up. Now, I don't know where you guys fit in that, but I would say that probably would describe what most people would do if they were looking at that type of situation. Now let's come back over, and now we've got a high, and we broke the high. And for people that are looking for reversals, again, they're going to start looking for some type of indication that that there's a change, that they want to short. So again, at what point in here would a person confirm it on a chart? And to me, when I look at this, I would say that there's a couple zones where people would confirm this on a chart or enter this on a chart. One of them would be right here. When I look over here on this side, of this equation, when we tried to rally back up and couldn't, I would say that a guy probably would come in here. If a guy was, I would say, a decent price action trader, he's going to be getting short right in here. And you have to say, in either scenario, did they get themselves in trouble? Would they have felt some heat? Would they have gotten rocked out of this trade? Would they have gotten decent targets out of it? And so on. Well, you can tell that the guy that got here would have felt like he's in the money, and then it comes right back through him. Would he have gone to break even and gotten stopped out? You have to say yes, he probably would. For your information, this is a tick chart, and this is about 4 points right here. So if a guy got, a 1.5 move on the S&P, which by the way, this is the S&P, if he would have gotten a 1.5 move, would he have moved his stop to break even? Very possible. Would he have gotten stopped out? Yes, he would have. Same thing would have happened right over here. He got in on price action when it broke this little green candle's low. He got his 1.5, 2 points, and it immediately came back and would have taken him out at break even. So I have to look at this and say, could we have identified something on the tape to get an entry up in this area? And I would say, for any of you guys that have traded with me, you see me do it. That's typical for what I try to look for when I trade. And I think, the guys that have been with me in the room for a while would verify that when I trade, very frequently the entries are within 2 or 3 ticks of a high, and we'll run them clear back down towards a low. That to me is one of my preferred trade setups. I like to look at this at the highs and at the lows, and that's what I'm examining. That's what I'm trying to find. So I have to say, if I could have got that up here in this area, up high, this would have allowed me to capture the bulk of a 4-point move, where here I would have just gotten to break even and gotten ticked out. Very likely. Same thing happens up here. You capture 2 3-point move. I'm scaling out at a couple points and at 3 points. It would allow me to get off a couple targets, and in getting to a couple targets at that point, I've got a runner, and if it goes for the low of the week, who cares? I'm going to be there. And if it turns around and takes me out on that last lot or two, then that's fine. I gave it a chance. That's all I ask for, is give it a chance to break yesterday's low, give it a chance to start down on a daily chart and so forth. So I have to ask then, what do we see up in these areas up top that would cause us to take the trade? So that's going to be the basis of what we're talking about as we go through these next series of slides. The things that we're going to mention here, I'm going to go through 7 different things that we could see on the tape, and this is not, I could probably come up with 3 or 4 more, but these are the ones that would be the most compelling to me. And I don't say that all 7 of them have to be there, but I do say that the 7 things would be there on any given day, and on any given reversal, you will see at least 1 or 2 of these on any reversal. So a guy may look at this and say, I don't need to see all 7. I don't need to see 5 of them. I really like this one thing, and when I see this one thing, that now is going to trigger my trade. So that will be the focus of the next series of slides, is the trade setup, and I'm going to have that little small chart on each slide. But for right now, unfortunately, I'm at 30 minutes. This is as bad as having commercials on a pick and TV show. But I'm at 30 minutes. I'm going to stop real quickly and save this set of the recording, and then we'll pick up again. So if you've got TiVo, just fast forward. Okay, so we're back. Hopefully that's not too disruptive doing that. It takes just a minute to do it because I have to take a 1 gig CamRec file, convert that to an AVI, and then save it. So it takes just a minute to process something that big. So let's get into the factors here, or the things that we would see at reversal points. Again, we're talking about these areas right in here, and I realize this is kind of a small chart, but we're talking about coming back up into that. When I talk about the 1 lot buy order speeding up, does anybody want to hazard a guess as to why that would be significant? Exactly, Brian. Newbies. You think about that. Why would somebody come back in at this point as 1 lot traders? Why would they come back in and enter? And again, if we were to look at this, let me go back. If we were to look at this little green candle here, we see 1 lot buyers coming in all aggressive. So at that point, I would assume that is likely new traders who think this is going to be a breakout. And you will see that very frequently. I think it's ironic as a trader, because I have heard so many professionals say trading reversals is a newbie strategy, and trading continuations is a professional strategy. But I'll tell you what, watch the tape and you will very quickly be convinced that at any little swing high, swing low, high of the day, you're going to find a million newbies in there buying that, and you're not going to see the big guys buying that unless it truly is a continuation. So if that's the case, one of the first things that I want to pay attention to is the 1 lot guys, the new traders that are coming in on this little pullback, and they're just streaming in, going long like crazy. Now again, that would be, when I say speeding up, that would be relative to the original rally that we have here. Relative to that rally, we have the pullback, and now the 1 lot buyers are coming in all aggressive. That would be significant to me when that is coupled with point number 2. We have the same point on the chart. The 1 lot guys are coming in, and the big orders are gone. You have to say, if that's the case, does that give you all the confirmation you need? Could you take it on that basis? Newbies are coming in, big guys aren't coming in. We don't even have to see sellers at that point to say this at this point in time, and I could be wrong, but at this point in time, this does not look like a continuation move. This does not look like it's breaking to a new high. We've got newbies buying and no big buyers. Now, we might see that change as this moves right up into the high. And again, I apologize, this is a small chart, but we're looking at this little double top. It comes up into that high. That could change, and if big buyers come in right at the top, what does that tell you when you're sitting here thinking about a short? You guys can throw it out there. I'll let somebody answer it. You're coming up into this high for the second time. It's been newbies, and now as you come right into that high, you're getting ready to pull the short trigger, and you see 15, 20 large buy market orders come in. Okay, exactly. So you guys understand this, what's going on. Kevin says wait. Brian says nope. When we're looking at this, it's telling us if we're thinking that's a short and we're looking at it for the reversal, we're getting ready for a reversal, we just got flagged off. Don't take the short. Exactly, Gerardo. If you got short, be careful. You better be getting out because you might have done the wrong thing. So what do we need to see then when it comes to the buy orders, the large buy orders for the market you're trading? If you're trading a market like crude, you don't see a lot of 10, 15 lot prints. So if you were going to try to sit there and wait for and Karen, I'll specifically reference this to your type of situation. If you were going to sit there and wait for a flurry of large buy orders, you're probably never going to get it. The tape is going to get very frustrating. So if you're trading something like crude and you come up into that type of a scenario, you're looking at it as a potential reversal area. If somebody does place a large order, what are you likely going to see on your tape? Let's say a guy comes in and puts a 40 lot sell market order on crude right into that high. Okay, speed increases. I would define it this way, Karen. I would say you're going to look for what appears to be a bot, because it's not very likely that waiting in the queue is a bunch of 50 and 80 lot traders. You've got a fairly thin dome. You know that most of the orders waiting in the queue are going to be one lot orders. And so you can watch the one lot buyers coming in, and you got buyer, 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 buyer. If there's a large buyer there, what you're going to see is half of your time in sales on your one lot side, your unfiltered side. You're going to see half your time in sales drop in instantly, not a tick at a time. And this is where it's, I think, very critical to have a no time compression on your time in sales. You're not going to see this drop in one tick at a time. You're going to see half your screen. You're going to see 40 or 50 lines drop in instantly. And in your case, that is probably going to be the warning that somebody's buying this through the high. You're not likely to see a 40 lot buy order, and you're not likely to see a 40 lot sell order if sellers come in. If somebody big comes in, you're likely going to see what appears to be a bot. And remember, that is just going to be the execution engine, the way that they're showing prints. That execution engine is just going to put through every single execution. So for you guys, and again, I really do encourage people to keep trading the instruments that they're comfortable with and that they like. Don't change to try to copy me or emulate me, but take the instruments that you're already working with and that you already understand and apply some of these things to it. So you have to stop and think about it then, the difference between Karen trading crude and Ken trading the S&P. What Ken would need to see is he's going to have to see that there's no large buy orders coming in. And if he sees those large buy orders, to wave him off the trade, he's going to want to see 15 or 20 of them come in simultaneously along with a big flurry on your unfiltered tape. But for somebody like Karen on the crude, she's going to need to see, to blow the trade off, she's going to have to see a big, huge one-shot push, where everything drops into place like we were talking yesterday. They've all got the same timestamp. They all came in instantly. And she's doing this with an uncompressed time in sales. Then she says somebody just placed a large market order to buy. So you may be anywhere in between there. You trade in the NASDAQ, there's a little more activity. You're trading the 6E, a little more activity. You're going to see some 8 and 10 and 15 lot guys coming through. And so you're going to have to correlate this back to what's normal for your market. Now remember, we talked about this yesterday. I will mention it again right here. To decide what's normal for your market, you're going to have to come in and say, out of any given 100 prints, what's the big prints? What's the large prints? And then you watch another 100. What's normal? Is almost everything 1s and 2s and you got a couple 7s? You're going to have to take your instrument and you're going to have to fit this to the instrument that you're trading to decide what you need to see to determine that there's no large buyers or that there are large buyers or that large sellers are coming in. Those to me are two critical things, and this would be foremost for blowing the trade off and saying, nope, not going to do it if this happens. When we come back up into that high, here's some additional things that will go on. Very frequently, as you come up into an area, you will see the print slow down. It's almost like everybody's lost interest in it. And if you see that happen, it's very possible that this is going to become a short-term reversal point. It might sound contradictory, but frequently you will see these fire off where you get this big flurry of newbies coming in. There's no big buyers in it. And then the prints slow down. And it's just like it hangs there. And you almost feel like, whoa, the platform just froze. And then the very next thing that happens is here comes a flurry of sell orders. So if that's the case, and I was looking at that trade for a short at that price, I would already be in. At that point, I know my parameters. I already, in my scenario, I already know what my potential target is before I run into this low. I know that I've got to get through this one first, but I'm taking the short up on this move here and saying it's time to go. Now, coupled with the flurry of sell orders, I've got a qualifier here, is that frequently you'll see the sell orders come through the first time, and it moves price down a few ticks, and then it might take 2 or 3 times as long to recover back up to that. And when you see that happen, again, these are things that can warn you that a reversal is getting close. So, you can pay attention to that, and at that point say, time to get my finger over the over the mouse, get ready to click that order in there. So, Pete, I see that you've got your hand up, and I'm not sure if you had a question or if you had just hit that when you put a comment out earlier. Did you need anything specific? Okay. I was just going to say if you had a question, go ahead and type it in there. So no problem. Point number 5. This is something that I would say is going to be more visible on the DOM. And you'll hear me, if you've ever traded with me, you'll hear me say this a lot. They can't go bid. They can't go bid. What I am referring to, and let's just look at a DOM here real quickly. The DOM, and let's reverse for the scenario that I'm talking about. Let's say they can't go offer. Let's assume that in this given point, here's our offer, and let's say that the sellers do clear this level out, and the offer drops back down, and then you see some buyers come back in, and the offer came in fairly small. The buyers come back in, and they clear that level out. And so now there's no offer at 28.87 in this case for this DOM. But the bid isn't here either. Let's just imagine that they're not here. They're not willing to step up to 28.87. Now, we start thinking about what that means when they can't go bid or they can't go offer. If the buyers will not step up into that, that would be one warning. They cleared out the offer that was there, but now they won't go offer. They won't move up in there and take that level. They won't come up here and hit 28.88. If we look at that type of a scenario, that frequently would happen around those turning points. If they come up to a level on the dome, they may clear a level out, but then they won't step in and take the level that they just cleared out, and they immediately lose it. You might look at the same scenario for the sellers coming in. If they got cleared out of 87s, and there's nobody at 87, will they take that level back? Will they go offered there? So see, if we're looking at this based on this type of activity, we could reverse that. It could be buyers can't get a level to go bid, sellers can't get a level to go offer. They're just not willing to step in, and what I always call it is firming up. You've probably heard that before, but when we talk about firming up, we're essentially talking about it that they take a level and they're not willing to come in there and build a nice thick offer at that price, or they're not willing to come in there and build a nice thick bid at that price. So you take this scenario, they can't get a level to go bid, and if they do put a bid there, it's a little small bid, and they can't firm it up. They can't get 300 or 400 to join them. If you're on the S&P, they can't get 700 to join them. It just sits there with this little teeny bid, and they will not step into it. Again, those are the type of things that you'll see. You'll be seeing this on your dome as opposed to seeing this on your time and sales. Now, if you're experienced with watching the tape, you will see this on the tape. And the reason that you'll see this is you'll see prints go off, like you'll see 28.87 go off green, where market buyers were hitting it, and then you see 28.87 go off red, you see 28.87 go off green, you see 28.87 go off red. If the same price keeps switching colors on you, it's an indication that they can't get that level. Somebody can't take that level and hold it. And if somebody finally takes that level and firms it up, then it's going to go that, they're going to take it the other direction. I don't know if that makes sense, trying to explain it that way. I think when we put a video here showing this, it will make more sense to that. These are some things we're going to be looking for later, and I will definitely have examples of these things in the video. But when we come in, and like Brian says, the bid dried up, they're not willing to step in and bid there, it's a good indication that we've got a turning point. The dome, again, if we have a small offer that's sitting out there, some markets you'll see this where the offer will get down 2-3 lots. Little tiny offer sitting there, and the buyers will not hit that and clear it out. They put a little small bid out there, and the reason I talk about this in this scenario is you don't just have an instant reversal. Even on a V bottom, you don't just have an instant, it printed and it's gone and it never came back. That's, the 1 out of 10 thing. You will always see these little scuffles, little fights. It may last 30 seconds, it may last 2 minutes, but you come in there and you think about that. In our particular scenario where we're sitting here looking for a short, is there's a small offer, the sellers have not jumped on it yet, but the buyers that were there will not hit that offer. They're not going to go market buy there. And then when you got the bid over there and somebody steps into an empty slot like crude or like the NQ or the YM, where you do see a spread open up here and there between the bid and the ask, the bid steps in and instantly a seller hits it and it's gone. Bid steps in, instantly a seller hits it. Those are little clues that you've got a reversal coming. And then I would say this would probably be frequently your final confirmation or your last thing that would happen, and that would be the big sell orders. And remember, we talked about this yesterday, the way that they're showing this to us on the tape, it's going to look like a bot order where half your time and sales drops in at once. Or if you're trading, like something thin, to see the large sell order, it may be 2 or 3 screens worth of time and sales that just blur by instantly with the same timestamp, and they're all sell market. So when you put that sequence of events there, it really helps us to appreciate that coming into that reversal, you've got a reversal on a chart pattern. You're coming into a prior high, you're coming into a resistance area, and so forth. Now you've got the clues to look for to either say no, not yet, not yet. But at the same time, you have to say this. What happens at this point in time on your tape? It may not give you the confirmation to enter, but it may not blow the trade completely out of the water and say, forget it. You may see it get one tick higher, and then the large sell orders come in, and you were just getting ready to blow off your short, and they make a one tick new high, and all of a sudden we got sellers coming out of everywhere. And then you say, okay, screw it, I'm still going. It didn't get high enough beyond it to convincingly convince me it's not a breakout. So you may still take that trade. So the thing that I want to point out is that just to watch for those things on the tape without looking at a chart probably won't be beneficial. That's not how you would trade strictly from the tape. And the reason for that is when you think about all the things we discussed, speed up, slow down, big sellers appear, big buyers appear, they disappear. Those things happen all day long. But when we come into a level that we've predetermined as a dynamic level, like we're coming into a moving average, we're coming into our Keltner band, and we see this activity starting to occur, and we say, that Keltner band just on its own is a 50-50 trade. That moving average on its own is a 50-50 trade. But coming into that price, if I see this on the tape, I'm going for it. The static level, we come into a prior high. I actually prefer, most of you guys that have traded with me know I actually prefer to see 3-4 tick new high on the S&P and just get a little poke above it, because frequently that's where big sellers are lurking, waiting for that new high. So when we come into one of those levels, we should be able to have a trade defined that is fairly clean. We look at that trade setup and we know this is step 1. We've got a price level. Step 2, that's going to be these factors on the tape. And when I see those factors on the tape, step 3, I'm entering the trade. That's the process that I've used for nearly a decade of profitable trading. And it's been through any type of market conditions that have existed in the last decade. I've done that on stocks. I've done that on indices. I've done that on commodities. And it's worked on every one of them. I don't trade options because I can't speak Greek and I can't understand options. I never wanted to waste my brain cells understanding options. I figured if you got to have a computer to figure it out for you, then it's probably beyond what I want to play with. But any market condition, I've traded this year after year after year profitably, and it's worked. So to apply this back for your own use, I would say define 2 or 3 of these things. You start trying to recognize these things, and as you recognize them, look for them on your existing setups. If you're already looking for reversals and you're looking for a reversal confirmed by by an indicator or two, take a shot at that. And as your indicator is telling you to go, you got to bear in mind that's probably a little bit delayed. It's a little bit lagging. But as you're coming up into those price levels where you might be looking for the reversal, ignore the indicator for a minute and look at your time and sales for these factors. See if you can identify those. Start experimenting with that and try to do that before you throw what you're doing out. Try to take this in and replace something that probably doesn't matter as much and that will just slow you down in the long run anyways. Now, I ask this And I think this is one of the most important things that you can get from tape is what is the best thing you can get from the tape. And I really do think in some ways the best thing that you can get from the tape is the ability to avoid a loser. If you've got a setup that works fairly well, you're still getting stopped out 5 out of 10. Can you dodge a couple of those losers by what you see on the tape? So let's go back here, and we're going to go to, hopefully I get this right, we're going to go back to this point, and let's imagine that we see exactly the opposite. Let's say that as we come up into this high, the one lot buy orders disappear. Newbies aren't buying. Let's say that as we come up into this high, not only are the newbies not buying, but we see that large buy orders are starting to come in. Let's say that as we come up into that and those buy orders are coming in, that they actually speed up coming into that high. Let's say that instead of a flurry of sell orders, we just have 2 or 3 orders that go off, and then more green, and then 2 or 3 sell orders, and we get the impression that they're taking profits, just in case, not that they're initiating new positions. Let's say that the levels, instantly when they take a level, buyers are stepping into that and they go bid there. They clear the offer out, they immediately step up, they go bid at that price, they firm up, thicken up, however you want to define it. You get to your dome, when there's a small offer out there, it's immediately hit. You get the bids that are put out there, they're not cleared out. And then any sell orders that come in at that point, let's assume they're not there. See, we went into this with a total impression of what was going to occur, and it didn't happen. So if that's the case, we got flagged off of that trade. Are we going to trade it both directions? You can. It just depends on how comfortable you are. If you don't mind flip-flopping back and forth either way, you might have gone into this with the expectation of a short, and you may turn right around and go long because of what you see. It can give you a trade either direction. A guy that's looking for continuations, what triggers you in as a reversal trader is going to keep him out as a continuation trader, and vice versa. So you can keep that in mind. I've got a comment here about that time and sales properties. I'll tell you what I'll do. I'll email you just a snapshot of that when we're done, and that way you don't have to go through the whole video to get to it, since you need to take off early. That way you can just look at that and make sure that yours are matched up. If anybody else wants that, I'm happy to send that to anybody else. If they want a snapshot of my time and sales properties or my dome properties, I'll be happy to send a snapshot out. Just throw it out here in the link, and I'll get your names before I close out. So the factors that I see here, again, if we can come in and we can take these factors to confirm the trade or to blow the trade off, typically we're going to eliminate 1 or 2 of those losers that we would have gotten. And it doesn't mean we don't have to be 90% win-loss to be profitable. I'm sitting just shy of 74% for the year out of all the trades that I've executed. I've had very profitable years and very profitable trades where I was running 50% because of management. But if we can get to 60 or 65, you can print free money as long as you can sit on a trade. The drills, we'll go through a couple drills real quickly, and then we'll allow some questions, and then we'll call her a day. We're just over 2 hours right now. First of all, when you look at your time and sales, one of the things that I encourage people to try to do is to put your time and sales right next to your dome. Don't look at the dome, look at the time and sales, and try to figure out where the bid and offer are, and then look at the dome, make sure you're right. Look back at the tape, figure out where the bid and offer are, look at the dome, make sure you're right. to me, if you want just like a memory aid, the bid, if you're configured correctly, the bid is red and offer is green. We got 3 letters, we got 5 letters. Bid is red, offer is green. Does that make any sense? Probably not. I'm kind of anal with little dumb memory things like that. But anyhow, I tend to look at it that way. Bid red, they're both 3 letters. Offer green, they're both 3 letters. So I see a green print. That's where the offer is. I look at the time and sales. I can tell you automatically where the bid and offer is. And if I see that flipping back and forth, back and forth, back and forth, back and forth, I know they're not firming up. They're not able to hold it. So start trying to work on that. Do that around times when it's dull and you're trading. You're not near levels that are worth executing. But just sit here and look at that and see if you can identify where the book is, where the bid offer spread is. Next thing that I would encourage people to try to do, if you know what delta is, fine. I'm going to give a very simple definition. The bid-ask delta, what that refers to is you take all of the trades that are executed at the bid and you take all of the trades that are executed at the ask. So we're talking about actual executions. We're not talking about the volume that's out there on the bid and the ask that's displayed in the book, but we're talking about the actual executions that went off at the bid. So we think about that. All of the trades that executed at the bid, that was market sell orders. And all of the trades that were executed at the ask or the offer, that was market buy orders. So if that's the case, they're going to take all of the market buy orders, everything that hit the ask, they're going to subtract everything that hit the bid or all of the market sell orders, and that's your delta. So if you had 1,000 buy orders and 200 sell orders, your delta for that candle or for that period, it would be 800. If you had 1,000 buy orders and you had 2,000 sell orders, your delta would be negative 1,000. Now, there are little indicators that you can use. You can put that on your chart to track that. And Ninja has some on their forum. I've got to brag about Karen, whether she wants the credit or not. She's got one that she's made that's very nice. I actually like it better than anything on Ninja's forum. But I would say, to me, I track that in my head. And could I come on the nose to the number and line up with Karen's indicator? No, I couldn't. But I could tell you whether the delta was positive or negative. So as you see those prints go through, if you're kind of keeping track of it in your head, see if you can start to figure that out. Grab the indicator off of Ninja's forum and put that on there, and then don't look at it and try to figure out roughly where it was in that candle. Now, if you can't do that, at least try to figure out whether it's positive or negative. The more buyers at the market or more sellers at the market. Because that is what moves the market. Market sell orders drives it down. Market buy orders buys it up. If you go back and look at let's say you take a 1-minute candlestick chart day after day after day, and you have the delta of those candles, about 98% of the time, every green candle, every positive candle that closed higher is going to have a positive delta, and every red candle, 98 times out of 100, is going to have a negative delta. There will be some times where there's a little bit of divergence. Some markets are a little bit different. Crude frequently tends to move because people pulled their offer more so than because there was a lot of buyers that went through it. But generally speaking, your delta will be whatever color the candle is. You'll either be close to neutral, you'll be positive on a green candle, you'll be negative on a red candle. But if you can try to do that, it can be a very handy thing to kind of run that in your head. Yeah, Kevin, you mentioned that there's a program called Market Delta. The problem with that for many people that try to switch to Market Delta charts, like the volume footprint charts, is it can give you a historical perspective, but it can also make a chart that takes a lot of thought to figure out where price actually went and where it traded. And if a trader had never looked at anything else and they learned on Market Delta, I think it would work great. But for people that have been looking at candlesticks for a couple years, to go back to volume footprint, it can take so long to process that it's not hardly worth it. That's what I really like about what Karen's done. Is simple. Yeah, you got buy sell volume on Ninja, which will give you that. You have to have your platform on and running. If you switch charts, it disappears and starts at that point. I believe it's not one that continues to record or update. We've got a question within what parameters, meaning do you calculate delta based on time, or is it regardless of timestamp? I personally tend to do that more on the basis of swings in price, swing high, swing lows, pulls back. What was the delta when it starts changing? Where does the thing change? I don't think that you have to sit there and know this. I think it's probably more valuable for guys that are using minute candles than tick candles. We're going to go through some of that in subsequent sessions that will clarify that a little more. But the point is, if you can kind of figure out where the delta is by looking at the tape, then you don't need the other things anyways. You can sense that the sellers own it. They're dominant. You check your delta. Yep, there was 2-to-1 sellers in that candle. You watch the next one. You feel like the buyers own that one. You check your delta when it's all done. And don't cheat. Don't look at a candle. Don't look at your delta footprint or your volume footprint, whatever you're looking at. Look at the tape, decide what it is, and then look at the candlestick and see what happened. Were you right? Did they truly own that candle? So Karen made a comment here that she's kind of getting the indicator cleaned up so that it works. It was limited to version 6.5 and trying to get that cleaned up and working on version 7. And she says when that's done, she could offer that for a very modest fee. It is a handy. I've looked at it, and for gaining a little bit of a historical perspective on that, I definitely think it's a lot cleaner than the one that's on Ninja's forum. It's definitely a lot cleaner than, like the volume footprint. I think, for what Karen's done, she has paid some individuals to do some programming for her, and if she could defray that expense, it's probably more than fair to do that. So if anybody's interested, let me know, and I can pass that on to Karen. And just send me an email if that's something that you have some interest in, and if you guys don't mind, I'll just forward your email to Karen. So, Tom, just send me an email, because if it's on this chat session, I probably won't remember to send you that. So just send me an email and mention that you would like to know when Karen's got that ready, and I'll give your email addresses to Karen, and Karen can contact you when she's done and let you know what she's going to do with it. So, another drill here. Let's go through these and we'll get finished up. When you're looking at your dome, we were talking about whether or not the bid can stay at a level, or whether or not the offer can stay at a level. And again, I think it's beneficial to be able to track that off the tape, because you're already watching the tape. At that point, if you can see it on the tape, it just eliminates having to stare at the dome. If you can't, you can't, but I would definitely say try doing it. And so what you want to do is go to an instrument like Crude or the YM, something where you frequently will have a one-tick spread come in there, and watch them jockey back and forth on the tape, and then try to determine whether they're able to come in and take a level and hold it. And what you're going to see when you do this is you're going to come in, let's just say we're talking on Crude at $80, and our spread is 80 by 80.01. So they come in at even, and we've got prints at even, and then we have prints at 01, and the color is the same. Now, if we have the same color prints at 0, at even, and then we print at 01, we know price just moved up a tick. But then if it immediately moves back to 0 and it's still green, we know they couldn't hold 01. They couldn't keep 01 bid. They lost that, and 01 is now offer. So as you go back and forth and watch this, you can see it easily on your dome, not as easy to see on your tape, but if you can see that on the tape, then you can pay more attention to the tape. Again, you don't divert your attention to two things. You're able to watch it on one. Will it melt your brain after a while? Yeah, but try it for 5 minutes. Keep your dome there. Keep it far enough away that you can't cheat, but kind of focus your eyes on the tape and see if they can hold that. It can be a very beneficial drill. And then finally, I would say, especially if a guy is trying to trade without frequent use of charts, but he wants to take some levels off of charts and then he just wants to trade off of the tape, the drill that you're going to have to do, the thing that you're going to have to do, is you're going to have to create in your head an imaginary tick chart. So you can start at any given point in time, and you could even draw it on paper if you want to, but it can be very effective. As you sit there and watch this, you see at current price where it is. Keep in your head what it would look like as a candlestick and where you are in that candlestick. You're right in the middle, you're in the bottom third, upper third. And so as it expands out and we wiggle back and forth, up and down, in your head you're building a candle. And try to make a little tick chart. Try to make a little chart in your head and figure out where the top of this candle would be, where it keeps getting rebuffed, and figure out where it would be on the low side, where the buyers come back in. Because that's going to be something that you're going to have to be able to do, essentially, if you're going to trade without the chart. You're going to do this in your head. So if you're going to try this, do this on the YM. I would say this is the easiest instrument to do this on for this drill. Is go to the YM, start building yourself a candle in your head, let it wiggle up and down, keep expanding that out. If you have to say it out loud, say it out loud. 58 by 59, 58 by 59, you're watching it. And then it expands out, 58 by 60, 58 by 60, 58 by 61. 57 by 61, they push back down. You keep expanding that in your head, and if you got to say it out loud, say it out loud. Once you start getting that bracket, at some point that bracket will become large enough that you can trade it as a scalper, and at some point you're going to be able to take that bracket, and when you break that bracket and you get a pullback into that bracket, in your mind you would view that as a Fibonacci retracement and you're going to take a trade. But this drill is where you have to start doing that. Now, we're going to talk more about that type of trading later. But for right now, this is where you have to begin. Is you've got to sit there and say, in my head, here's this candle, here's the high, here's the low. For a beginner, do a high-low bar. As you get better at it, you'll almost subconsciously, you won't just have a high-low bar. You'll have a candlestick where you've got your open and close. You know where you started tracking it. You know where it went for lows. You know where it went for highs. You know where you are right now. And not everyone can do that. If you can't do it, don't feel bad. I've always said I don't think one person out of 1,000 could, but a couple here have asked about that and wanted me to address it. So I'm going to show you how to do it. But I would say if this gives you a headache after 5 minutes, don't waste your time. Because you'll still be getting headaches in 3-4 years, and there's things on the tape that you can take out very quickly. There's no reason to take 3 or 4 years trying to do this just so you can trade without a chart. I will stop there. If there's any final questions, throw a yes out there, and we'll address the questions. And if not, we've got I don't know where we're at. I guess we're about 2 hours and 15 minutes, 2 hours and 20 minutes. And if not, we'll stop there for the day before we all have a mental meltdown. Like I say, give me a yes if you got questions. Otherwise, we'll go ahead and bail out and call her a day. Appreciate that, Andrew. Thanks. So you guys go ahead and just put your questions in. I got a couple that have questions, so go ahead and throw that in there. And in fact, while you type those questions, I'm going to stop my recording and save that. I don't want to go too long unless the questions are real brief. Yeah, Kevin, whole thing is on video, and you should have gotten an email from my account at YouSendIt, and that account has a link to let you download. Yesterday, like I said, I had to re-record that, but there will be a link each day. I was able to edit it together very quick and put a very brief table of contents in, so I will send a link each day. I will go back through for the time and sales and the DOM properties. let's go ahead. For those that wanted it, it's out there, and I will pull that out of the log before I close. I will jot down who wanted it and send it out to them. Actually, you know what? It'll be easier. I'll just send it to all of you, and then if you didn't want it, just delete it. I'll just send a snapshot to everybody. That'll be easier than trying to write it down. Can I do the drills on the 6E, or does it not lend itself for what we learned today? Some of the drills will work better on the YM. I would say especially the last one, where you're trying to build the candle in your head. It will be more effective trading the YM than it will the 6E. But you can do the drills on the 6E. You can do the drills on anything. It obviously would be easier to do the drill on gold because they're coming in slow, but it really doesn't matter. I would say if it's hard to keep up, go to GC. Go to your December GC or your February GC. I can't remember which one's becoming active right now. Should be rotating into February gold pretty soon, if we haven't already. I can't remember where we are. November 1st. Yeah, we still have a few days on December GC. But if you can do it on the 6E, do it. If that's what you're looking to trade, Sean, do it on the 6E. So, it's not, there's no wrong answer there. But I definitely would say of all the instruments that I've traded without having a chart up and visible, the YM in reality is by far the easiest, and it's probably the only one that I would do it on a consistent basis if I was going to do that day by day. I wouldn't mess with it on the S&P, wouldn't mess with it on the 6E, wouldn't try it on crude. They just don't move in a pattern that works with the way my brain processes. So. Well, I think that covers everything for questions. Don't see anything else coming out there. I appreciate all the comments and the thank yous from everybody. And like I say, I will have a video up probably within a couple hours, and it will just be a low quality recording that you'll ultimately want to delete at the end. And if you don't want to download it, don't worry about it, because we will have the full recording later. So I appreciate the input and the questions. I have only received a couple trade setups, and so if you guys still can take a quick snapshot of where you like to take trades and send that to me, that would be great, because we can give some personalized advice for that. I won't be talking about it for another day or two yet, but if you can keep some of that stuff coming, it will be beneficial for everybody. So. Thanks again, everybody, and you guys have a great day. Like I say, I will send out everybody a snapshot of my property, so we don't have to worry about that. And anybody that's interested in talking to Karen, send me an email, let me know that, and I will pass your name to Karen along with your email address. And I'm assuming I have permission to do that. And then we'll be back in at 12 p.m. Eastern tomorrow, and we'll again be right about 2 hours or so. And at least this time we know we got the recording of it. So thanks again, and we'll see you tomorrow.